For doing a good job in portfolio management, we always have to remember there's two major things we need to accomplish. One is the asset selection. Second is optimum allocation of asset. Let me repeat. First is asset selection. Second is the optimum allocation. Now, how do we select asset? In this reading here, it provide you some criteria for selecting the right asset classes. Now, remember, we're not trying to do an individual asset like stocks or bond, but it's the asset classes. So, how do we define asset classes? There are five criteria that we can specify or determine the asset classes before we do the selection. So what are the asset classes? There's a five criteria. We need to memorize it. The first is that the asset inside the class have to subject to this homogeneity. The homogeneous characteristic of all those individual assets in the class have to hold. So in other words, they are very similar to each other. Statistically, all right, we are able to do that by selecting the high correlation. So those assets are highly correlated. Okay. Now on the other side, outside the class, among different classes cross-sectionally, that correlation have to be low. In other words, they're not highly correlated with each other in terms of asset classes. So one, we're looking for high correlation inside the class, but we are looking for the low correlation. There have to be low correlation outside the class. And then third one is that all those assets has to be investable. Right? The investability is important. Otherwise, you're not able to really allocate them through the trading. In other words, if it is not investable, the time you want to rebalance, like you want to sell it, you're not able to find a market to sell those assets or replace the asset. In related to the investability is the liquidity. All right. Those assets has to be basically majority has to be the liquid asset. So that means we're able to sell when we need to sell, and we're able to buy that when we have a time need to replace the old one by the new one. Okay. So these are the four very important. The number five, the individual asset cannot be classified into more than one class. So that means they should be those assets has to be the classes have to be mutually exclusive. So if one asset in the one class cannot be appear on the other class, mutually exclusive. So these five criteria we have to remember that homogeneity inside the class of asset. Second is the low correlations, all right, among asset classes, investability of asset, liquid asset, and then mutually exclusive, all right, of asset among classes. So these are the five important criteria to determine asset classes. I want you to pay attention first about tips. Tips is a very unique asset class. They actually subject or satisfy those criteria, right, for a very unique independent asset class. TIPS is a treasury inflation protection security. So it's a treasury, like a treasury security is a fixed income type. But usually, right, we don't classify TIPS, all right, or either is like a nominal bond or equity. It's a different than a bond and equity. It's a very unique asset class. Why? Okay, first criteria. tips are strongly correlated to each other. Okay, all right. Tips is very unique because it's inflation protected security. So the different types of tips, different maturity, all right, different nominal value, all those tips are strongly correlated. That's one. So it's subject to highly correlation inside the class. Second, the tips has a very low correlation with other classes like a bond or equity. Why? Because nominal bond or equity, all right, it's not necessarily inflation adjust. Right? It's not necessary. Like treasury bond, it's not inflation adjust. And since the tips is inflation adjust, even though the inflation is very low, but since the inflation adjusts the character, the correlation is very low with other type of classes. This has put that tips become a very attractive asset class for risk diversification. We know that for reducing risk of a portfolio diversification, we're looking for asset had a low correlation, right? Low correlation with other class. So tips is very effective, very relatively well cheap, and importantly had a high liquidity. All right, so it's a very liquid market. There's a very interesting characteristic is that the volatility of tips depends on the real interest rate, where the nominal bond, other treasury bond, depends on the normal rate. So real interest rate is the base for tips, where the nominal rate is the base to calculate nominal bond. The tips is actually why I use that because it's inflation adjusted. Therefore, think about it. One based on real rate, the other based on nominal rate. What is the relationship between nominal rate and the real interest rate? The correlation tend to be very low. That's the reason why tips has a low correlation with nominal bonds. That created a huge value for risk diversification. Okay. Another advantage or character I did not really specify here, but just mention, tips is our liquid asset, because tip had a really well functioning, all right, dealers market there. So tips is very liquid asset. That's another good advantage of using tips as asset class. Another one, final one, the tips calculate based on consumer price index. Therefore, during the high inflation period time, okay, tips can effectively hedge the salary increase in the pension benefit. So in other words, a lot of time the salary increase maybe is caused by just the inflation. So if you're using the nominal bond, then the increasing of salary does not really help to increase the real return. However, if you use the tips as a vehicle to manage your pension fund, then since it's based on the CPI adjustment, the tips actually provide you the most effective way to get the true return. All right, so that one is another interesting thing. Other than tip, they are server classical asset class, traditional asset class. It's pretty straightforward. You can take a look at that one. It's equity and fixed income. So in equity, fixed income also can classify by domestic and international. Right. So international is important because the whole purpose is served for diversification. Then in addition to equity and fixed income, we also have alternative investment. This one, we need to pay attention to it. Like real estate, private equity, PE, right? Natural resources, commodity, currency, and other hedge fund investment strategy. But remember, if you're using alternative investment as different type asset classes, make sure that they need to satisfy these 5 criteria. This usually appear in the exam Right? It is definitely not just ask you to memorize. They probably give you the question, say, oh, where is a commodity a good asset class for diversification? Please, you have to judge that whether that class had subject to this five basic criteria. Another one is always remember cash and cash equivalent is another asset class. Okay. Sometimes we ignore that because we thought cash will have generate no return, so it should not be an asset class. It is asset class. All right. Now, in this reading, also provide you a very important and useful tool I would call criteria to determine whether we need to accept the new asset and replace the old asset class inside, all right, new asset class inside your portfolio. So here my question here is that should we add a new asset classes to the existing portfolio? What is the criteria we should do that? And here I view this as a very powerful tool and very unique and very useful. Okay. Now, the thing to do this one here is two major things. All right, two major methodology or parameter. One is a Sharpe ratio. Second is the correlation. Let me repeat. Whether we should add a new asset to the existing portfolio. Is this a good one or not? Selection purpose. One, Sharpe ratio. All right. Two, correlation. Sharpe ratio and correlation. Let's look at this formula. Sharpe ratio. What does a Sharpe ratio do? Sharpe ratio is measuring the risk adjusted excess return. Let me repeat. Sharpe ratio is the risk adjusted excess return. So here saying that it's expected return of the new asset minus the risk-free asset. Risk is the excess return, right? This is the additional return from the risk-free rate divided by the volatility of the new asset. So this is the excess return adjusted by the volatility. So risk adjust. Suppose we got this one. The Sharpe ratio, suppose we calculate here, it's say 1.3. Should we select this one? We compare this Sharpe ratio, the new asset, to the existing portfolio. If our existing portfolio Sharpe ratio is okay 1.5. Okay, this is the 1.2 and this is 1.5. So 1.5 basically perform better than 1.2, right? But does that mean we should exclude that new one? Wait a minute. Depends on that correlation. Let me repeat, all right? The new asset have a Sharpe ratio 1.2. The existing portfolio have a Sharpe ratio 1.5. The existing portfolio is better. However, what about the correlation is only 0.5? It's only 50% correlate. In other words, the new asset provide you a powerful diversification because of low correlation. So 0.5 over 1 times 1.5 is only 0.75, which is much lower than the 1.2. That means the 1.2 Sharpe ratio from the new asset provide you better return. Not on better, I would say risk adjusted return, excess return, than the existing portfolio because that correlation is low. So this is a very interesting, right? So next time when you do as a portfolio manager, you ask two things. What is the Sharpe ratio of the new one? What is the correlation of that asset to the existing portfolio? If the Sharpe ratio is higher than the existing portfolio Sharpe times the correlation, then we should accept that. Okay. So risk adjusted excess return and diversification, there are two effects we need to consider simultaneously. In summary, the best diversification vehicle. I probably wanted to say the best performance vehicle. Okay, that vehicle is an asset class. The vehicle asset class that had a higher risk adjusted excess return. I mean high Sharpe ratio with low correlation with the existing portfolio. This will provide you the best performance of your portfolio. Finally, in terms of asset class, then you say, what about currency class? Does the currency risk is important, all right, for us to consider, need to be considered for portfolio performance? Well, the answer is not necessary. Okay, not necessary. What happened is when we do international investment, if you talk about currency risk, it must be the international investment across different country. If you cross different country and you do international diversification, the purpose of that is for long-term purpose. And then you're looking for the risk of diversification is based on market risk. The market risk is a long-term concept. Why you care about the short-term currency risk? Simply, you're not going to trade that asset oftenly, in and out, in and out. So the currency risk, it's not an immediately important factor will affect your performance. Then it's not important to consider because they are not additive in your risk, portfolio risk. So currency risk is this is one justification about why we don't need to consider the currency risk for international investment. The other argument or justification is that a currency risk can be hedged away. Okay, hedged away. The correlation between the asset return in the local currency, the local market currency, uh, local market. I mean, talk about asset return risk and the change of currency. In other words, the change value of exchange rate, the correlation is very, very low. All right, it's not very high. Low correlation between the asset return in the local market and the change in the exchange rate is usually less than 1 and is low. Therefore, you can actually put that one and hedge away. More importantly is number 3. Since you're holding the portfolio for a long-term purpose, we know that for all exchange rate, it's a mean reverting process. So it will go up and down and up and down, but it always toward to the mean. So therefore, holding for a long period of time, the currency risk will decline, right, over time. Therefore, with the mean reverting process of exchange rate, we may probably ignore the currency risk for international investment. Okay, so these 3 are important points that you need to put in an exam to justify your answer.